Did we not go? Good evening, ladies and gentlemen. It took a second to go live there, but today we got to talk about the futures, man, because the market is in somewhat of a correctional territory. Could it be a crash? Could we start seeing AI deflate? Is that a bubble that we're starting to see the cusp of the burst? Nobody really knows, but what I can tell you is there's trends going on right now. The market is definitely shifting more toward these cautionary plays, which is super fascinating. And everyone's getting pretty psyched up, even though, the S&P is down about 5%, give or take. The NASDAQ, the tech heavy sectors are getting absolutely devastated right now. And we're going to transition this into these kind of, I don't even want to call them recession plays. They're just more of plays people typically go into when they're shitting their pants about what's happening with the market. And I'm going to break this down into bits and pieces. And yes, we're going to talk about these Canadian dividend stocks because they play into this kind of, just these stocks that people are flooding to right now. And there's a huge, microscope on it. I mean, you can see it clear as day. It's just a matter of how long does the trend continue, or do we look at picking tech up on the dips? And I'd love to know what you're doing in that comment section below, because right now I've been very fortunate that my portfolio for the most part is only down about 3.5%. Tomorrow it's going to be down a lot more, but in the backdrop of how much things are dropping, some of these stocks are proving to be a little bit more of these safer plays when it comes to these Canadian dividend ETFs, even though they're down. V&Q is still done very well. SEHD is only down a couple percentage points. But I really want to talk about, again, the plays that are kind of just unfolding in front of our eyes. Because, again, you can't argue right now that people are scared. And these sell-offs have nothing really much other than to do with the fact of a few things we're going to look at. And it plays into that AI thing, right? Like you get into these hype cycles, everyone gets so pumped when things just keep going up. And then it's not even that reality is setting in as much as the psychology of the market shifting and the VIX taking off scares the shit out of people wanting to lock in profits. And then you got to get this perpetual sell-off, right? And that perpetual sell-off is coming in the companies that people are most fearful of right now because of earnings growth, which are the major tech companies. Again, AI materially is only affecting companies like NVIDIA. For the most part, those are the companies that are taking all. I feel like the AI boom, for the most part, is largely being drawn forward by our money coming out of the earnings of other mega tech companies. NVIDIA on its own isn't just getting that growth from going out there and selling it to the end user like me. Because obviously, if they were selling it to the end user like me, like Apple, like Tesla, like a lot of companies, they wouldn't be doing that well because the end consumer is still a bit constrained. We're seeing it in data, right? People aren't where they were a couple of years ago. So when companies like Microsoft and Apple and all these big AI plays, Meta, Amazon, all of them are AI plays today, but none of them can actualize any revenue out of it. So that's the dilemma that we're in that leads to these bubblish territories when all of a sudden earnings that we're seeing out of Apple, for example, Apple is trading at a 34 times multiple during a period within its history where it's only growing in single digits. I mean, net profit was only up 2.84%, operating income, at least you're getting like 10% is a good way there, but revenue at 4.8%. These growth rates are honestly quite, fantasized because it's based off future expectation of growth. So that's the only way these stocks are commanding these high values, because Apple does not deserve to be trading at a 34 times multiple when it can't grow into that multiple anytime soon, right? So this is where people start kind of freaking out a little bit, and they're like a little concerned. Same thing with Microsoft here. Microsoft is underperforming the S&P, which is crazy because it's the leader, arguably, that started the whole, AI revolution, purchasing ChatGPT and, proving the huge growth there, even though it's an unprofitable company. If Microsoft was smart, they bring ChatGPT public, actualize a crap ton of hype in the market, pull a bunch of revenue out of that and just capitalize on it, dilute a bit, raise capital, get it so the company can float for a while, but they're not doing that. So they're in the same dilemma as everybody else. They're not actualizing any growth that they haven't seen before in the past. I mean, 15% growth on a company like Microsoft is incredible for like revenue and stuff, and even operating income's going up. Like they're in a good position, but this isn't as good as it was a few years ago. These companies were growing higher into the 20 percentile range, and now they're kind of at this more modest, literally typically between that 10 to 15% range, with the exception of a few companies like Meta, right? And even Meta is slowing down on its current growth rate. So when you look at companies like Microsoft here, again, trading at the upper end of their price multiples, it's no surprise that it doesn't take a lot to kind of distinguish, is that the right word? Distinguish? Probably not. Extinguish, the hopes and desires of people's idea of future AI playing into revenue models. So this is, like I said, right? Like you're pulling ahead all this stuff that doesn't exist, and you get overhyped, and then you go through these secular periods where people get underhyped and a little concerned, if anything. And depending on how much that hype took over some of these stocks, it's going to debate on how big the correction is, right? So all that money right now, for the most part, again, not necessarily leaving the market in droves. Obviously, some of it's probably going to cash, but you're seeing it starting to get absorbed in companies that aren't actually having great earnings. I mean, Procter & Gamble's earnings weren't great. The stock tanked on it. Yet as soon as the whole market started to turn in this direction, boom, it just completely recovered from probably not the best earnings report it's had in its history, right? McDonald's, same sort of deal. Why is McDonald's going up? Their earnings are fine. They're not great. Johnson & Johnson, these very consumer defensive oriented stocks, like these are very foundational companies that people will run to in times like this. Even though, again, I wouldn't define these as companies that are at their prime right now, right? Like even Pepsi has been struggling. These companies, they've been raising prices, fighting the consumer on how high they can raise them versus volume shipped. And most of them are seeing a balance of like equaling volume. It's not like volume's increasing organically. Like these companies are having a hard time. Yeah, here we go. Here we are, right? So I think the true defining factor to this kind of shift in the market, I think, is going to start coming out actually tomorrow. And a lot of that has to do with a pure kind of AI play, or so it's called, which is Palantir, right? Now, Palantir is arguably one of the most expensive AI stocks that I've been saying has been in a bubble for a while. I don't understand it well enough to buy it. Same with NVIDIA. I don't understand it well enough to buy it. And this company has a crazy amount of value pulled forward that it has to now justify in growth. And this, I think, will be a good exemplifier if they can post good enough numbers to get the market excited. I mean, stocks like this will be the turning around story, I think, if we can pull it off. If this company comes out, blowout quarter, justifies this, you're getting 30% rev growth, they actualize a lot of the income that they have kind of control over on their balance sheet, and they just, explode their EPS, they could justify this. So that's the real question, right? Like, are these companies just, is there future value too pulled forward for the growth that we're getting in the current market environment? So there's a couple ways we can play this, right? The first way to play it, is to look at these tech companies and recognize that if I'm a long-term investor, I'm not retiring for 20 years. How low do I want this to go before I'm going to start aggressively cost averaging into it, right? Like the NASDAQ here is now below where the S&P's performance is, which is really interesting. It's down over 10%. It's probably one of the biggest correctional periods we've seen in the NASDAQ, in a good couple of years. I mean, I don't know if we go back to a period where we see like a 30% correction. Nobody, I'd like to believe that's probably out of the question. I still feel like we're in a correction, and it's very likely that the Fed's going to cut rates, and we're going to see these stocks start to recover. So, I'm kind of stuck in this line right now. Like, is this trend going to be a little bit longer lasting? And are we better, these companies, these dividend oriented companies, these defense oriented plays, these foundational plays, are they better to buy in now because they're suppressed and the yields are higher? And this is going to be something that continues. So, I'm really paying attention because the S&P hasn't really corrected enough to get me excited, right? A 5.6% correction, it's still like meaningless to me. If this dropped 10% or more, I'd be a little bit more amped to buy the S&P. So I feel like, again, if you're wanting to trade this a bit, you have more balls than I do, perhaps. Like I'm always watching the Qs because, when the NASDAQ tends to start to turn around, the triple leveraged Qs are usually a pretty good buying opportunity. Because over long periods of time, like this is excelled market performance. If you believe the NASDAQ isn't like a bubble that's correcting right now. I mean, this is highly risky. This isn't something I recommend for everybody, but it is a fascinating thing to consider. Even if you're doing double leveraged or triple leveraged like S&P, these are really fascinating ways to play it. But let's shift into the conversation of choice here, which comes into earnings with these Canadian stocks, because for the first time ever, and I mean in a long time, it feels like we're finally seeing a material turnaround in these kind of, utility-oriented stocks, these defense plays that people are starting to take a liking to again. And Talos has been one that's on my list. The wife owns it. It kind of prevents me from buying it because I don't want overexposure to the sector. But you got to recognize we wiped out a decade of value in capital growth. And it's all because of interest rate sensitivity that is now in Canada being cut. And it's accelerating. I mean, they're doing a lot more cuts than I think people were anticipating. So it looks like we're kind of in that cycle now. And Canada might be getting the edge on the US when it comes to this. And this is going to be a good indicator to what might happen for US stocks that are in similar things like Verizon, right? So if you take a look at the earnings, however, like this is one of my favorite telecom giants just because of what you're going to see right here. This is the diversity of their business. And I don't even think does it take into consideration? Yeah, I mean, it doesn't show the exact security side because they do have a security side of their business, which could be part of fixed equipment and other service revenue. Not quite sure, but mobile revenue continues to grow. Mobile equipment and other revenues are actually down a little bit, not materially by much, from 503 million from 519. It's not bad. Fixed data service is actually up. Fixed voice service down a little bit. Fixed equipment revenue is down a little bit. Health services are up a little bit. And then you got agricultural and consumer goods services, which are actually up a nice little bit by like 15 percentage points. So all in all, their revenue, you're not seeing like crazy growth, but it's increasing 1% year over year. It's flat, it's stable. And they're going to start seeing that nice oomph from the interest rate cuts finally start to go onto their balance sheet. Materially, I think we're going to need to see at least 1 to 2 percentage point cuts. If we get to 1 to 2% cuts in the base rate, and then all of a sudden you give it a couple quarters to let that start baking into these corporate line of credits, I'm sure we're going to materially start seeing a turnaround. Now, Fortis, if you're into utilities, which this is arguably the most fascinating play. Again, I'm not buying these. I'm looking at them, and I'm just putting this out here because I want to know what you guys are doing because I'm not sure even what I'm doing in this market environment. I'm kind of amped to look at tech, but as somebody that wants to fast track retirement, understands that things are kind of valued here. Do we kind of shift more into these kind of plays that are going to see much better interest rate cut growth? I'm just, I'm like twitching out trying to figure out what the best plays are here. Because like I said, Fortis, again, is this a short-term thing? Is this just a blimp? Is this just something that's happening out of a short-term fear-based movement in the broader markets? Because, these utility plays is something that I've heard people like Kevin O'Leary tout, because obviously with the huge demand for electricity that's about to happen, these utilities are crushing. I mean, they're seeing good growth. Net earnings, for Fortis, they're actually up pretty nice from 294 million to 331 million. Again, we're not talking like tech-like growth, but in a market environment like this, for the yields you're getting and the values in these companies, I don't think they've been pulled forward enough for the consideration, because there's no guarantee interest rates go back to wherever. But I think it's logical. We can presume they're going to go back down probably to somewhere closer to the 2 to 3% range in the beginning, and then maybe even likely below that. So Fortis, I find interesting. You could look at things like Hydro One. I think another really favorite of mine, but is doing exceptionally well. I mean, Hydro One's on fire right now. Southern Company. This is another one of my favorite, U.S. utilities. And this one's on fire right now. And again, I'm looking at this as if this is the beginning of a new trend, right? Again, these companies, some of them are trading at a bit more higher values. Southern Company, don't trust this. Don't trust utility price to earnings because you have to take into consideration depreciation and amortization costs. But man, you can't help but recognize, the trend is your friend. This is why I take profit on some stocks. This is why I play a little bit with a small percentage of my portfolio. Because again, you look at this and you got to ask yourself, if this is something that's going to continue and this material shift keeps happening, like I said, it's pretty in your face what's going to happen. Look at companies like Enbridge. I mean, pure utility plays, right? I mean, Enbridge, these companies, I can tell you, they ain't going anywhere anytime soon. And they just posted earnings. And the earnings, again, we're not talking tech growth, but when tech is starting to deflate more in line with some of these companies, you got to ask yourself, are you better off buying a utility that's more likely trading at a 10 to 15 times multiple if you take into consideration depreciation, or are you better off buying something like Apple that's trading in the high 30s? So like I said, very interesting psychological debate on how you feel about what's happening in the next, 6 to 12 months. So again, I'm a long-term investor. I'm still buying ETFs. We're going to talk about that in a moment. I'm just pointing out these fascinating, things that are happening because they're just the EBITDA is now at 4.33 billion, which is up quite nicely, like year over year and year to date. I mean, look at year to date over last year, like from 8.4 billion to 9.2. They're not doing terrible by any metric, and they're still doing huge acquisitions for natural gas players in the US. So I think Enbridge has some good potential still in the midterm. And then you also have companies like British American. If you're pure yield oriented, British American is looking pretty attractive here too with a 10% yield. It's starting to recover in a very aggressive way. It's up 27% now from the lows. The earnings on this one, again, they're so much better than Altria Group is. But again, they're still seeing declining across their entire segments because of, tobacco sales are slowing down, but they're seeing huge growth in vapor globally. And revenues continue to still kind of trickle toward, their all-time highs, which is good for them. Gross profit still kind of flat, but increasing. Cash flows have been doing pretty good on this company. So you can lock in a 10% yield. This company's done a good job managing cash flow. It's interesting, right? It's an interesting take on the market. So we'll take a look at some of your questions, comments, and then again, we'll kind of rope this back around to like my thoughts with my portfolio and kind of the tweaking itches that I'm having, which there's no guarantee, and it's pure fugazi, and I'm a clown at best, so don't take it as any financial advice. But we'll start at the top because you guys are talking about a lot of stuff. So the NASDAQ has more to correct. So yeah, again, if it's a correction or if it's a bubble, right? Because the big concern too is, like I mentioned, you start getting the gravity of large numbers. We could end up reaching, peak potential sometime soon for companies like NVIDIA. So if NVIDIA starts seeing its growth rates cut in half, it's going to start having a harder and harder time justifying a 60 to 80 times multiple. And if NVIDIA starts to correct heavier, especially on its earnings, you're going to see a lot of fear, and the NASDAQ's probably going to correct a lot heavier, and it'll bring down the whole chip sector with it, right? So, there's a lot of variables at play here. I still think, like I said, I don't know how low we can go because I still think these companies are powerhouses, but you got to ask yourself, right? Like, how big is Amazon going to get? How big is Microsoft going to get? We don't know. I think there's huge potential long run, but at the scale of large numbers, even these companies growing at 10% is kind of maddening. It's insane. It really is something unheard of that you couldn't even fathom 10 years ago, that these companies could be making, $500 billion a year and growing at a 10, 20% clip. Again, this is why I like Meta a lot. I still feel like Meta is probably one of the most powerful plays because it's got some of the highest growth, the best valuations, and stuff like that. Palantir may be overvalued, but has very healthy balance sheet and a sticky business. Where would their clients go? No, I agree. But again, you have to justify the growth because again, with companies like Palantir, you're talking about, what's the market cap on Palantir right now? You're talking about a company that I think is growing rev at around 20% or something like that. And it's trading at a $55 billion market cap at a 206 times PE. I don't trust the PE because I think they can control some of their expenditures to bring up their earnings per share. But what they can't do is manipulate the revenue growth, right? So if we go back into the financials here, you're paying $50 billion for a company that's only generating $2 billion in revenue and like gross profit of 1.7, right? So, you're paying a fucking hefty premium for a lot of future growth that has to justify that value, right? I'm not saying it can't. There's nothing saying that it can't. It's just, again, you can't argue value. You can argue speculation, and we can argue the speculative future of the company, but that's what drives these wicked mood swings in stocks like this, right? So you got to be a little careful. Rotation out of tech into interest rate sensitive stocks. So yeah, that's the play that I'm personally looking at, which, when it comes to my stocks, this is why I've been buying some of the REITs. And I told you guys, like I was shifting my focus into the utilities and the REITs, which is why I've been buying V&Q. I've been able to build V&Q up to almost a $10,000 position in a fairly quick period of time. And it's actually been doing pretty good, but I don't think it's going to do as well as some of the defense plays because real estate, again, if we go into a further recession, there'll be some concerns, but I do like the revenue growth of a lot of the top REITs in V&Q. And I do recognize the cash flow should start to increase as interest rate cuts come, especially that if we get that first one in September in the States. And considering how wickedly and violently a lot of REITs in Canada have snapped back just within the first two interest rate cuts, I'm presuming we should see something similar in the States, but should be more dramatic, if anything. Because again, the US always responds in usually 2 to 3x whatever happens in Canada. So I'm betting on that. It's a bit speculative in nature, but I'm taking it at a much more broad, safe, I think it's a safer way of doing it, but I'm giving up some higher rates of return for it. So I'm looking at V&Q still, but I'm also, again, looking at utilities, and I'm having a hard time being like, I have hardly any exposure to utilities. So I'm debating on, do I buy them individually or do I try and find the sector exposure through an ETF? But then again, there's that hard debate. If tech keeps correcting the way it's correcting, do I wait? And instead of buying the utilities, do you buy tech? Because I'm still a huge believer in the future of tech. So, man, it is such a hard thing to wrap your head around. And it's something you have to answer personally for yourself, right? What are your thoughts on C&Q? They have done a fabulous job. If we're talking about, I was going to talk about it because I talked about it in my last video, and same with some of these stocks. I didn't really want to get into it, but when it comes to like C&Q, they posted a fairly reasonable earnings, and they're down. A lot of the energy sector outside of Enbridge, and I don't know why, are trading closer to the downside. C&Q is a good stock. But again, I'd rather own it through something like VDY or the broader ETFs. Same with Enbridge. Like, these aren't stocks that I'm buying individually because I get good sector exposure in VDY. But I mean, it's a good stock. I got nothing against it. It is starting to pull back, which could be semi-buying opportunity. Interest rates going to help REITs, telcos, banks. Yes. So for banks. I think banks should have done better in this environment, and they didn't outside of JP Morgan and some of the mega caps, because technically the higher the interest rates are, the more revenue they tend to make. And same with insurance companies, right? I would avoid insurance companies right now because as interest rates drop, they're cash heavy businesses, and they're not going to be able to actualize as much revenue or earnings anymore off the cash they have. In banks, however, presuming we don't go into a recession and things stay the way they are, and banks can stop putting loan loss provisions aside, that'll be the next bull run for banks. Banks just need to see less weakening in loans. And as soon as that levels off and they stop putting loan loss provisions aside, their earnings are going to absolutely skyrocket and banks are going to shoot up dramatically. I promise you, if that happens, that's what you're going to see. However, there's that still economic risk of, things get worse. Interest rates doesn't matter for banks because the end user is just struggling a little bit more and loans are still weakening, right? So there's risk with the banks. I think there's less risk perhaps with utilities, because even if the economy gets worse, they'll cut interest rates quicker and these interest rate sensitive stocks will recover quicker. But that doesn't mean the banks will do better. So it's kind of the risk. TSX tanked more than QQQM. I'm holding cash for a bit. International also tanked, seems worldwide. I think China's been in a recession for a while. I think the real estate market tanked. I don't like global stocks as much as I like Western stocks, but I do recognize, European, you get Hershey, British American Tobacco. I do like some of those companies. However, I wouldn't go into cash. I have a cash emergency, like $9,000, but I don't stop buying because there's always something out there that's going to do well, or there's always a discount. Like I can look at 10 stocks right now I'd want to buy, but I'm also not a degenerate gambler who's going to overload my portfolio with companies. I'd rather try and be strategic, pick one or two I believe in, like Tesla, and when it works out, it works out. If it doesn't, I can buy more if I believe in it enough. Is EMB reliable going forward? Yeah, absolutely. What the stock does, I don't know, but reliability, I don't think you get more reliable than you would with a company like Enbridge that will do exceptionally well in an interest rate cut cycle because they're infrastructure, right? Infrastructure companies. And they're doing very well. Their earnings were very good. Even in the volatile oil market. If you're young and have time, QQQ and sleep well, knowing that you will actualize on phenomenal long-term gains by the dip. Yeah, I'm a strong believer in the Nasdaq. I wouldn't go 100% though. Because there is always risk that you end up heading into a recession. You pull forward way too much earnings, and you see another correction of like 30 to 50%. That's when I'd be more inclined to be like heavy Nasdaq. It's great when it corrects a lot, but in markets like this, you could start cost averaging. I think is good, and always cost average, but I still wouldn't make it the sole amount of a portfolio. Because again, look at my portfolio, right? Like I'm down 3% in a market that's not doing nearly as well. Again, I've seen good upside with this portfolio too, right? Because it kind of gives you those secular rotations. So like SCHD is doing pretty good. These stocks are not doing phenomenal, but they're doing better. So I like the balance. I like income. But again, you got to find your own balance with that. You could be 100% growth. It's just, it scares the shit out of me when you see massive corrections in the market, and can you handle those volatile mood swings? Especially with when you look at companies like Palantir, where people got excited buying Nvidia, Palantir, and all these tech stocks like literally a month ago, and now they're already down 30 to 40+%. And now you're kind of praying to God we're not in a correctional period, and you weak hand your way out of it. Enbridge has cut their dividend, unless I'm missing something. Did they cut their dividend? Did I miss that? I'd be shocked if Enbridge cut their dividend. Enbridge, let's just take a quick look, because I thought they had a dividend growth thing, dividends and common shares, because they've been paying their dividend for 69 straight years, and they've announced a 3.1% increase. There's no way they cut their dividend. I have a real hard time believing that, because they pride themselves on it. It's the same thing with Fortis. Like a lot of these companies, they primary orient themselves. Let me see if I can show you guys real quick. Let me pull this up. Bada bing, bada boom. So they literally gloat on their website. And I looked it up. I'm not seeing, because even here, right? This would have been the last update. I think Enbridge paid a dividend for over 69 years of shareholders. In November 2023, we announced a 3.1% increase, which was probably the last increase. Yeah, oh no, wait, maybe you're right. Look at that. No, it's up. It's up. No, sorry, I was reading this backwards. It's up. They're not cutting the dividend. Their last dividend payout was 91.5, unless they announced it on the earnings and I missed it, but I doubt it because their earnings were great. Someone's going to have to let me know. If a bailout is imminent in the coming months, do you then look for assets with an interesting debt profile? That's what we're doing. That's all these stocks we're talking about. They all have higher debt than tech companies, so they're interest rate sensitive. A lot of Nasdaq stocks are like Apple, where they are high PE, but the growth rates have stalled. Yeah, no, exactly. That's the issue. But we don't know if they've stalled. That's the dilemma. Like, they're still growing. It's just that they're not going up a lot. They're starting to trickle down. So again, is it a trend? We don't know. The next earnings could be the same as they were this earnings, and we could still trade at higher PEs. Palantir grew only 10% year over year. It doesn't justify 50 PE. Kyle has a tendency to hate Palantir because I have been preaching it since 2020. Ask Maddie. I don't hate Palantir. I think it's been a great stock, other than it's been just incredibly overvalued since basically the IPO. I think the only good time to buy it was when it dipped. But now, again, it's the swing, right? Like, I think Palantir, the buy of the century, was literally when the market tanked. And a lot of companies like Palantir were, they were great companies. I just don't understand them, so I avoid them like the plague. And I don't think most people understand them, and most people shouldn't be buying them. Again, this is kind of comes back to the point of, like, if you're trying to outperform the market, you're talking about a company here that most people probably bought, when it was up here, and they got shittered, and they all sold out, they all lost money. And then down here, smart people were like, hey, this is a good company. It's good value. And then all of a sudden the AI revolution came into play, which had nothing to do with the value of the company. And then, like, the company exploded on AI revolution, even though the growth rates are pretty nominal for now. I mean, they're good, they're nominal. And what's Palantir's growth right now? Let's just take a look, because I'd rather look at the exact numbers here. So, there's, like I said, there's nothing wrong with it. It's just that, it's come back a bit, but 20% is nothing like it was when it was growing at 30 to 40%, which justifies a 50 plus times multiple, right? So this continues to go up, like it's been trending. It could continue to go up, and it could be a good stock. There's just a lot of risk because it's pulled forward AI hype. And AI hype is AI hype. In a recession happens because of world war. Watch out for oil prices. Buy at the bottom. I don't play oil that much. Not a big fan. Sup, man. Sup, ball. Is EDV a hedge right now? What is EDV, man? What the hell is EDV? The best hedge you can buy is a hard challenge, because everyone's going to be liquidating their high interest savings account. So this is Endeavor Mining. You're looking at mining stocks. Endeavor Mining PLC is a multinational mining that owns and operates gold mines. To put an example, look at the growth of this company in a time where, this is another hard dilemma. Am I not sharing my screen for this? Where the fuck screen share? Here, bring this up. Did I just lose it? I'm an idiot. God damn, I have too many tabs up here, folks. I was just pulling it up and now I lost it. Una moment, por favor. Here it is. So with companies like this, like, the thing that I find most perplexing is gold is trading at multiples that it hasn't seen in decades, and it should pull forward a lot of gold stocks, and it's not. So gold is trading at an arguable discount for most gold companies. I always find it interesting because I don't trade these. I don't like commodities that much. But yeah, look at Barrick Gold, right? Like, how is this a possibility when gold is trading at, endless highs? So I would say they're at discounts, but people just don't care. It's a hard reality to face sometimes. I wouldn't buy them to be, again, if you like it, sure, it's all you, but I'm not a fan. I'm getting back into golf, being outside a lot. Congrats. Golf is a business game, my man. Golf is a business game. Rate cuts should be okay for banks. Yeah, we kind of got some of these. What else we got here, folks? Give me something new, damn it. Give me something new. I bought BNS, has done well recently because of their Latin America exposure. Canadian banks, man, Pokemon cards, they're great income. They're great stocks to buy. You want to buy them as a basket because National Bank's crushing, Royal Bank's crushing, BNS, TD are getting hit, but cyclically they tend to come and go out of favor. So I do like them a lot. Just got slapped on Intel. There was a story. I'd share it with you guys. Maybe I should try and pull it up real quick. It's fucking hilarious. This guy, degenerate gambling again. This dude just inherited. I shared it in the group, but this dude just inherited like 800 grand from his grandfather that passed away. And I wish I could screen share this right now. It's so funny. Yeah. So he's like, I bought $700,000 worth of Intel stock today when it was trading at $30 a share. Wrote a whole spiel about it. Put 100K in cash, 700K in Intel, and then it went down to 20. And I don't even know if I can't pull it up. It's going to take too long and I'm too lazy. But there's a nice little like meme of grandma here where it's just like your grand in heaven watching you lose your entire inheritance on Intel stock. These fucking people are stupid, bro. It's the same thing with everything. Palantir, you're going to see it with like even MindMed, these companies we used to trade. I have a story of MindMed in a video. The dude deleted his post. He invested like 800 grand, $1 million in MindMed at the top. Probably just lost all of it. It's too funny. It's too funny. Well, luckily I'm only down 120,000, bro. You must be loaded, man. Maddie's loaded. To say you're down 120 and you're a guy that's probably buying ETFs and shit, bro. that's that's a privilege rather than it's a brag, if anything. What do you think of Amazon drop? Amazon's cool. I have a love-hate relationship for Amazon because all their money they make is bullshit. It's literally just me transacting with other people buying my products, and I'm using Amazon as an infrastructure to like sell and manage my products. So when they say they're doing 500 billion in Amazon's not the one doing the revenue. I'm the one doing the revenue. I'm using their platform, right? So it's kind of a deceptive play because like when they're doing $500 billion in revenues, it's a $500 billion in transactions technically, and they're not even profitable on it for the most part. So it's kind of a complicated thing because they're so integrated into how we live today that infrastructure can't get disrupted. They're a beautiful system, but it's just a really complicating thing where all their growth is coming from AWS. So it's I've never been able to wrap my head around the value of it, but I do like the stock. I've never owned it. I think the wife actually owns Amazon individually. I do like it. It's a good company. It's just I can't sit here and tell you what it's worth. It's very, very hard to understand what the value of a company like that is. What's happening with Bitcoin right now? It's tanking with the rest of the market. Like when these crashes happen or these corrections, it's a cyclical sell-off, right? It's more of a psychological thing than it is anything else. Because again, like why does everything sell off roughly kind of in the same tandem, and why is this not loading? I'm trying to show you guys the Bitcoin price chart right now. Yeah, I mean it's at 53,000, right? So when speculation leaves the market and crypto is speculative, I mean it's the first thing to go, right? I mean Bitcoin's at 53 right now and it's dropped 10%, which is a good sign the markets are going to shit tank tomorrow. I mean it's just a sign of the time, right? Is Palantir a good value? No. It might be soon, but it's not right now. Depending. Earnings tomorrow will decide. Go back to the beginning of the stream. Vanguard, EDV. I'm looking at the wrong one then, good sir. If Vanguard's the EDV and not the gold stock, unless it's a gold ETF, who knows? I'm an idiot. Sold 50% of his position, tax purposes, capitalizing on higher value. Rest in peace, Intel shareholders. Yeah, Intel is a good example of you just don't know what you don't know. That's sad, man. Uranium and silver. Yeah, if you're a commodity player, uranium's still doing pretty well. Any thoughts on Boeing? It's a piece of junk. On touch it with a 10-foot pole. They're just getting the astronauts back after 2 months in space, and it was on a Boeing Starliner. The CEO finally stepped down, and now we've got a astronaut that's the CEO of Boeing. Avoid it like the plague, man. Forget airlines. High margin business, baby. Either play the trend or play the margins. Don't play things that are cyclically horrible companies. Ryokan earnings later this week. I'm also very excited to see because again, the REITs are having a comeback, so it's something that's worth paying attention to. Hey man, just got in. I'm thinking to create a corporation to buy stocks and grow it within the corporation. What's your thoughts on that? TFSA and RSP maxed out. Do it all the way. If you have corporate income, I'll do a video shortly on how to maximize corporate investing. It's like the third triangle piece to the Canadian dream, in my opinion, is figuring out your TFSA, RSP, and then a corporate investment account. It'll change your life. What do you think of Disney? Rough patch. Avoid it like the plague. Disney's garbage. I'm like, this is all right. We're in lightning round. I'm just going to skim through this real quick. We'll let you guys enjoy your long weekend. If you're in Canada, if you're in the US, enjoy my rambling because you're going to get to see a crash tomorrow or at least a continued correction. But Disney is a garbage stock because it's cyclical in nature and they're competing in the world of streaming. YouTube is the superior streaming and an entertainment place out of everything. It's better than Netflix. It has higher margins than all of them. They don't have to pay for the content, whereas Netflix, Disney are pumping way too much money into content. That content now has been drained out because you got to remember, there was a time where every Star Wars movie took like 5-7 years to come out, and now they're banging Star Wars things out every year to the point where people don't give a shit. Nobody wants to go line up at a theater for a movie anymore. So Disney is it's a garbage stock that's in a time, the golden era of cinema is over. Now we're in the era of streaming, and YouTube is winning the streaming game and in the entertainment game, right? I mean, Twitch is winning the streaming, but entertainment as a whole, YouTube has the superior product for now. What do you think of EQ Bank? I'd have to take a look. I'm not going to get too into it. I'm in the same boat, Mo. Blessed, hate paying tax on margin accounts. Disney, go woke, go broke. Thanks, brother. Greatly appreciate it. Please make a video about for us Canucks always. Thoughts on Google? Google's got a good price right now. I think Google and Meta are continually being the best stocks in the market. I think Google still has some tail end risk depending on what search does, because search is arguably dying for them at a very slow rate. It's not growing anymore, which is why I still think Meta is the ultimate play over Google. Meta's growing quicker. It's got a better value. But Google is a good stock for now, presuming they don't lose too much search, which again, they're losing. They have the dominance, but they're still losing. They've peaked out in like people start, go look up the data. It's so hard to find. Google goes out of their way to not show you daily active users because they know they're competing with Meta, all these AI tools now, and it is taking a little bit away from them. As long as Disney, I'm more interested in ATD these days for long haul. Yeah, it's not a bad stock either. Alimentation, Couche-Tard. I like AC, not let in. Is Copilot, then Google Now. Yeah, but again, the problem is like if you go onto WhatsApp, you have Meta's Chat GPT search thing. It's up there. Mohammed Salah, it's Kyle. What are you asking what my real name is? Trying to hunt me down, bruh? Trying to hunt me down? Passive income investor is the name. Being a clown is the game. Let's go. Over 20% rev growth every quarter for Meta during the last year. Yeah, Meta's pumping a lot of money into VR, which I'm probably the biggest advocate for VR. I play it 4 or 5 days a week. I am in more shape because of this thing than I've ever been in my life. I'm actually like super built right now. And everyone, I just went to dinner today and the guy's like, man, you're stacked. He's like, what are you doing? I'm like, I'm playing VR, baby. 2 years deep into VR, 4 or 5 days a week, get my heart rate up to $140. Oh man, I owe Meta so much. Not only do we make good money, but Meta's going to be a long hold, I think, for us. Kyle, how do you feel about converting Canadian to US at this time? The is down, and it seems to head. It seems to be ahead of the US when dropping rates. It sucks. Yeah. So when the US drops rates, we're going to likely see the US dollar start to correct a bit, just because obviously people are going to be flooding out of cash-oriented investments and high interest savings and blah 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 blah. However, I will never look at the Canadian dollar and debate when's a good time to convert. I'll always convert. I constantly convert money. I don't care if it's up or down. I can't trade. I don't trade currency. I like US dollars. And when I get CAD, I'll convert it. I don't care. I know I'm losing something, but over the long run, I've made way more. What's your thoughts on BCE dividend play? BCE is interesting. I just don't like that they have so much exposure to Crave and their legacy media business is dying. It's the only reason I don't like it, which is why TELUS is arguably the better play. TELUS has better growth. It's got better diversity in its businesses. Still can't believe I missed on the Meta. Meta's still a good buy. It's dipping now too, isn't it? I mean, Meta's still a great play. Even if its growth rate drops down to 15% at a 24 multiple right now, its forward PE is getting into the teens again. It's trading back toward a favorable value, and it's got the smallest market cap for growth. It can easily grow. I mean, it's at $1 trillion. This company could easily grow into a $2 trillion valuation within the next couple of years. I wouldn't be surprised at a 20% growth rate, right? Sup, Patrick, just jogging into VR. Nice. I love it. BMO is interesting. Just buy all the banks though. Just lifted a ride bicycle, not into the VR. But yeah, folks, I don't know. It's interesting. I appreciate 110 of you hopping in for a good time tonight. I got to do an office tour still. I was debating on doing it in this stream. I kept talking about the stupid shit that I buy, and I'd love to show you guys my creepy office setup because I'm a Halloween nerd. And I do like the cynical mindset. I do like some weird things. I'm a bit on the macaw side or whatever you call it. Nice chatting with y'all. Yeah, I agree. I hope you guys have a great long weekend. I hope this was an invigorating stream of what the fuck do we do here? Are we going to be buying tech? Are we going to be buying defensive plays? I'm always a bit conservative, so I always take the conservative play, probably for the most part. And that could be buying tech if it's down or not. So stay cool. Stay awesome, folks. Have a wonderful weekend. Peace.